Hello, and welcome to HYCM's webinar on support and resistance, drawing the correct levels and how to view them properly. I'm really looking forward to this webinar, in particular because this topic is a really important one. In many ways, it's not as important as some people make it out, particularly when you're a beginner or a new trader. There can be a certain amount of anxiety about correctly identifying support and resistance levels. The good news is they're actually quite easy to do, and with a little bit of practice, you can work out how to do them and how to make sense of them. The key really is when to use them and how to use them, and we'll be touching on that as we go through this seminar as well. Not only how to draw the levels, but when to use them, and also how to use them to identify entries, exits, and take profit areas. Those three key sort of things that you need to execute a successful trade. So just giving everyone a moment to attend and to sign in before we get into it properly. Just a quick look at the disclaimer there, just we're waiting for folks to gather and to join. So just a reminder again of what this webinar is going to be doing. We're going to be introducing the concept of support and resistance, going through some of the key levels that we have and how to identify them, show you the different types, and use them to identify entries, stops, and exits. That's what we're going to be looking at. So without further ado, we'll get started. And the first area of support and resistance that we're going to look at is probably the first thing that comes into your mind when you think of support and resistance. You think of horizontal support and resistance levels. And these levels are arguably the most widely followed support and resistance levels that they are in the market. And that's simply because they are the easiest to actually draw and identify. Having said that they're the easiest, and particularly when you're starting out trading, you might think to yourself, well, how do I know I've correctly drawn a support and resistance level? I don't know if you've ever found yourself doing that. You're putting a support level in and you think it's in the right place, but you're not sure. You then see price comes up to your level and maybe goes through your level by 30, 40, 50 points, and you think, oh, I got that wrong. Maybe you put your stop on the other side of the level and you got stopped out. Or perhaps you've seen a level and you've marked it, but as soon as you've marked it, you've had a sense of doubt, thinking, I'm not sure if I've actually drawn the correct level. Well, I'm going to help you with that, because it's something that, particularly when I was starting to trade, I actually struggled with that and found that a difficult thing. I sort of had in the back of my mind this nagging doubt. Oh, have I done this correctly? Have I drawn the correct level? And the key thing to do is to think of zones and not lines. I'll say that again. Think of zones and not lines. A line is definite. It's either on this price or it's not on this price. A zone is more indefinite. There's a wider margin for error. And to help with this concept of thinking of horizontal support and resistance as zones rather than lines, I'm going to give you an illustration. Now, the illustration is a good one, but it might it might gross you out a little bit, but it will certainly be memorable. And if you look here, we have a very large man, and this large man has a really, really big belly. Now, if you imagine getting your hand and pushing your hand into that man's belly, when you first push it in, there would be a little bit of resistance. And then the further you push your hand into that man's belly, the more resistance you'll get, until finally you can't push any further. And that is essentially That is essentially what a zone is. It's an area of increased resistance. It's not a definite line. It's like, just as you imagine, as you put your hand into the man's stomach, you slowly get more resistance until finally there's a point where you can't go any further. And that is how horizontal lines of support and resistance work. They're zones. So you begin to hit the outside of the zone, the outside of the belly, and then you might get a little bit of a friction reaction, but you can still push in, and you can push in a bit further until you actually reach the belly. The very bit where you can't push any further. That's when you know you've got the full extent of the zone. Don't worry if that hasn't helped you. We're going to be looking at some examples on the charts just for us to help. Now, we're going to have some examples of finding horizontal support and resistance levels. And I'm just going to jump out of here, and we're just going to go into the charts and start looking for some of these levels. So let's take one of the major pairs. Let's see now. Let's take let's take the dollar yen here. Okay, so we're just going to zoom out, and we'll start on the weekly chart. Okay, so if we were looking at drawing support and resistance lines, horizontal support and resistance lines on this chart, say we're looking from left to right, you know, the first very obvious one is here. Okay, it's that level there, 116. Okay, so it's 116. It's an important handle, 116. It's a round number, and you can see that here, here, and here, and here, there was a reaction of price. It's a clear reaction. It's an obvious reaction. Now, if you're looking at that, you know, you might have heard some people, and what they say is, they say, okay, when you're drawing support and resistance lines, you only draw them on the body of the candle. So you might look at that and say, okay, that's my resistance line there. It's the body of the candles that hits most of the bodies here and here. Maybe you know, you could do it a little bit higher up there. Okay, so some people might say, well, that's the level there. There's obviously some merit, and there's a lot of minor levels within here. But you see, when you start to think of this, instead of thinking it as a line, you know, you might think, okay, this is the support level here. It's 116.08. Instead, what you want to think about it is a little bit like that big man's belly. Think of it like more like there. You see, it's more like a zone. And if you zoomed into that zone, you'd see a lot more reaction. We won't do it now because we're just looking at identifying the levels. Okay, so I hope that's beginning to come a little bit clearer. Let's look at some more levels here just while we're here. Let's look at one to the upside. And here we see, look, that would be a clear level on the weekly chart there. And again, you'd want to maybe have it like a zone. So you'd look at that area as a zone. And one key thing to watch is, you can see where that became a swing high, that was obviously a key level. Once that became a swing high, we had a swing low, and then we had another lower high, and then we had another swing attempt at this 122, 121, 122 level, and price was rejected down. So there, okay, you got 2 points of contact on the resistance level. At this stage, this is resistance. And look, as soon as price bursts out at that level, you can see that was a clear rejection of these this level here, and that was a broken resistance level. So when a resistance breaks, you would look to trade in line with the new direction, obviously depending upon the fundamental and some sentimental analysis that you've done. You wouldn't just do this randomly. Okay, moving on along the chart. All these swing highs offer potential places for drawing levels. So you could draw a level there, draw a level there, draw a level here. That would be just if you went down to the daily chart, you'd see these levels more clearly. There, here, you see this is previous support, comes resistance. This would have been a really good place to look for a short if there were some really fundamental reasons and sentiment reasons why dollar yen was selling off. As soon as it comes back to this recent support that's turned into resistance, that would be a good place to enter the chart. But again, don't think of it like a line, because see, if you thought of that like a line, you could easily end up, you put your sell order there and maybe think, oh, I'll give it 40 points. You're going to get stopped out really easily. So it's more, you want to think about it as a zone, and you want to be looking in that zone and watching price on the smaller time frames. Okay, let's get rid of some of these. I think that's going to be pretty clear for you now, how to draw them. And obviously, I'll just quickly go to the daily chart to show you how this works out. On a daily level chart, you see you would have got two touches here at the 170.50 kind of level, and you would have wanted to draw this in as a zone. You would have been thinking, okay, this is my kind of zone. I've got a previous support here, term resistance. Got the first touch there. Okay, that is my swing point. Anything from there to about there would have been a key kind of zone. So the key to it is you want to be looking for reactions. Now this might seem like quite hard at first. You think, well, how do I know if it's going to be there or it's not going to be there? But often the kind of the market itself, you'll know the mood of the market. You'll know, okay, well, look, if price reached here and there was some key data that was out, and that key data was going to be dollar yen bearish, and then it suddenly came out bearish up here at sort of 108 or something like that, 107.83, you would instantly know, okay, well, it's a clear sell because I'm at a really key point. I'm at a previous swing high. It's an obvious sell. So some of this becomes obvious when you're actually in the markets and you're at key levels and key zones. It's not something that is too difficult to look at. Let's go back now, and we'll have a look at support and resistance now, and we're going to have a look at it in particular to see how to place our stops. Here's a very obvious example here, and this is a screenshot of the Euro US dollar weekly chart, and I just showed on the chart, this was something I took off my my terminal, and you can see here there was a very key support level. This is on the weekly chart at 1.0300. That level was tested here in March 2015, tested October 2015, tested January 2017, and you can see on the upside you've got a key resistance level at 1.1500. Again, you want to be looking at these key kind of handles to get a sense. Any number with a 00, 500, 600, 700, 1.000, they are significant because if you think about traders or that a large institution or a big fund, they're thinking, when am I going to put my money in the market? They're looking at these significant levels, and round numbers tend to be very popular for targets, for levels, and it's just simpler, isn't it? Rather than saying I'm going to put in 1.04479, you can see the support level. No, you say, okay, basically it's 1.0300. That's the entry. That's the order I'm placing into my terminal. It just makes more sense. So in this instance here, what you would have done is saying towards the January, February, say you got some key data out of the euro, and you suddenly realize actually that further downside to the euro looks very, very unlikely. maybe you got a sentiment shift, or some new information from the central bank, maybe some forward guidance that was indicating that the euro was going to be appreciating, and you're thinking, I want to have a longer term swing trade. Well, all you could do is enter your swing trade and place your stop on the other side of this 1.0300 level. And by placing your stop on the other side of that level, you know that actually it's only if your analysis is completely wrong that you're going to end up and be stopped out. So you would then think, well, where do I want to target on a large swing trade? Well, then you've got a number of different targets on this chart, but the obvious one just to point out here is the 1.1500 level. This large overhead resistance level. You can think, well, that might be a place to target. It would be an obvious place to target. We'll have another look at a recent example on the pound US dollar chart. Let's have a look here. Yeah, here we go. So let's have a look at the pound US dollar chart, and we can see, seems to have closed. Let me just open it again. Okay. Now, so we'll have a quick practice drawing our support and resistance levels. You could see, okay, where is a key resistance level recently on the pound US dollar? And you think, okay, yeah, this swing high here was a resistance level. You've got a support level here. You've got support level here on these lows. And you've got a retest of that resistance level here. So if you were, looking at this, anywhere in this kind of region is going to be a resistance level. So you've been looking at this quite carefully, and if you were looking as price is breaking through here, you're going to be looking, for a strong reaction. This is how you got a supply level. You got a big supply level here, from here to there, and on that supply level, you've got more selling interest is going to be there. So anywhere in this zone is going to be a really key place for shorts. And what we'll do is we'll drill down into the intraday charts, and you can see, okay, there was a large sell candle here that sold off very strongly, and that was what's called Boris Johnson's candle, because as you know, the Great British pound is undergoing quite a lot of selling pressure at the moment due to the Brexit negotiations that are going on. So as soon as you saw that strong rejection from that level, you could have thought, well, okay, it looks likelihood that we're going to get lower prices. And all you would have done is entered a short. If you were at the terminal and you saw that Boris Johnson data coming out, entered a short, put your stop above the high of the Boris Johnson candle. So what you would do is you wouldn't necessarily need to put your stop all the way up here. You could just put it above that candle there, because if that's the catalyst for selling the pounds has been the resignation of Boris Johnson, then if you think lower prices ahead for the pound, then all you do is place your stop above that candle, because price has to go above that candle for you to be wrong. And then you might have looked at it on the daily chart and think, well, okay, and then where would be a good place to have a target? Well, then you would have looked, okay, the obvious support level would have been coming in around this kind of area. So anything from there to about there. So anywhere here, you'll be looking to take profit. And you can see that there was profit. This is essentially going to be profit taking from traders, just taking that profit as soon as price dips down into that key kind of level and that key kind of zone. So that's how you would use your horizontal support and resistance levels for identifying them. And think of zones. Don't think of dead straight lines. You can do a lot better by doing that, and then also having them as targets. So maybe look at one more example. Let's have a look. This was a trade I took on. Yeah, this is a trade I took recently, and it was a short New Zealand dollar US dollar trade, and I entered in around up here 0.6830, that kind of region. I won't go into the reasons that I entered. It was a specific technical setup, and it'll take too long to explain. It's not the purpose of this webinar. But I entered there, and my stop placement was above this swing high here. So I was confident that that was a swing high. So I placed my stop above that swing high. So I had my stop above that swing high, and then I was looking at price dropping down. Now, at first I was looking for a break of these lows, but what happened, we sort of started stalling around here, and I had identified that this kind of level here would have been a potential place to take profit. And so when I saw some of this rejection and hanging around and bouncing around, I quickly realized that I want to pay attention to this, because we're getting a little bit of support here. Price dropped down again, and I think it was around this day here. I stayed up for the CPI data coming out, and it was like on Monday or Tuesday this week. And when it came out, I remember seeing it, and I knew that it was a little bit soft, but it wasn't like terrible. It wasn't like a real obvious miss. And then I knew that they were having this new CPI core inflation release that the Royal Bank of New Zealand prefer, and that was coming up at like 3 a.m. and I'd stayed up till about 11:45 p.m. my time to get the trade. I'd sort of set my alarm, got up, had a look at the charts, and then when I saw the reaction, it was really suspicious. I'll show you the candle with you. Yeah, this is it. You see, I saw the price was in that support level. I could have taken profit. I didn't. I held for the CPI data because I was expecting a soft reading. And this is the candle when it came out on the 16th. And you see that was a really suspicious candle for me, because the price sold down and was bought all the way up. And I just saw that and I thought, you know what? I'm going to take my profit now, because I don't want to stay up till 3 a.m. waiting for the CPI data to come out, and I don't want to wake up in the morning with all my profit gone. And I was really pleased I did that, obviously, because you woke up in the next morning and almost all my profit would have gone. Now it sold off subsequently, but at the time I didn't want to be risking any of that, so I quite simply just took my profit there, and then price shot up. So that was just an example of how I was managing it. And for me, the way I was managing it, it was this drop into this support level. That's what I was really focusing on. And that level is still there. So going forward, you've still got this resistance level here, and you've got the support level. It's like a kind of zone that extends from there to kind of there, anywhere, and that's kind of the key kind of areas that you've got at the moment. I draw it a little bit further down, really. That was really the upper end of where you want to put it. Okay, we'll just take a pause now and say, if you've got any questions, anything you'd like to ask, please do put any questions into the box. No, I think that's okay. I'm gonna carry on here. Okay, right, let's have a look. So we'll go back to our presentation. Okay, so we've covered support and resistance levels. We're going to move on to Fibonacci levels. Now, the Fibonacci tool was named after a 13th century Italian mathematician, Leonardo of Pisa, and he was known as Fibonacci. And he was the son of a Pisan merchant. He traveled a lot and he traded a lot, and he developed this formula, the Fibonacci numbers, and they're kind of found, extensive, strangely, throughout the natural world, and they also are used in trading as one of the most common trading tools. And it's used in different ways, but the way I think it's used the absolute best is in the instance when some news is released and there's a sudden spike in price. Okay, and this sudden spike in price is almost always because of the release of some new element has come into the market, and people are selling. And what happens is two phenomena happen. First of all, on that initial price spike, traders will sell on the news and take profit very quickly. Often, if you've got 30, 40, 50 points in a couple of minutes, you might think, I don't want to risk seeing this go, so I'll take profit. And so the combination of profit taking leads to price often retracing. And as price retraces, you want to use a Fibonacci level in order to rejoin the move. And this is something, again, that is best seen, experienced, practiced to really understand. But I've got an example here that I just pulled out recently. Now, here we go. Now, this is a little bit of news that happened recently. It's in middle of June of this year. And what happened is, on this large candle here, the European Central Bank surprised the markets in quite an interesting way. What they did is they announced that they would be beginning to end their quantitative easing program, which would normally be quite bullish for the euro. However, when they announced that they would be tapering and ending their quantitative easing program, they also announced at the same time that they would not be increasing interest rates until about September 2019. And the euro sold off very quickly on these figures. I remember this trade. I got in this trade and I sold off, and I made quite a few points on the initial drop. As the news was coming in, I sold, around here, and I took profit off down this region. I can't remember the exact numbers, but I made a decent profit, and I was out of the move. Okay, so that's what a lot of traders would have done. They would have been in the news, they'd be looking at the feeds, either hear it on the Squawk, entered the trade very quickly, made their quick profit, and taken profit, because this was also like if I remember correctly, this was like a daily support level as well. It certainly was after the second retrace here. And what you would do in this scenario, so you came to the terminal and maybe like you're swing trading, you work a job, and you can't always get these kind of trades. And you can see this is a 4-hour chart, okay? And you think, well, man, I missed that. Well, don't worry, because all you do is you draw your Fibonacci tool retracement. You go from the left to the right, okay? So you would draw your Fibonacci tool retracement from the top of the candle which brought the news to the bottom of the drop down. That's your initial drop. And then all you'd simply do there is put your order to go short. Now there's really 3 different places where you can go short, and they are it's varying degrees of aggressive trading where you put your sell limit. So say you see the initial drop, you've put your tool in, and you're thinking, where is price likely to get to? Well, there's 3 key areas you want to be looking at. You want to be looking at the 38.2 retracement. you're going to be looking at the 50% retracement and the 61.8% retracement. Okay, there will be the three key levels. Now, ideally, you want them to match with other levels. So if you look at the, see that swing low there, see this area here through to there would have been an excellent place to enter a short. You know, price retraces up to the 61.8% fib level. Now, your stops are placed there conservatively, okay? However, what you can do is you could place your stops at the sort of 78% fib. So you could have put it up above here, or even if you were really aggressive, you said, well, I'll just put it here above the 200 moving average. But you know, for now, if you're learning, just do it like this. Put your stop and place it up there, and you could have entered the trade there and played it back down into the support level, and that would have been your obvious place to take profit. And there you would have made, you know, roughly 1 times what you risked on that trade. It would have been a really good place. Let me show you an example of this today. And this is the pound US dollar pair. Okay, I'm going to actually take you, I'll put this on the screen. This is from my terminal. I've entered short using exactly the same method here. So let me go over to the charts and we'll do a worked example together. Okay, so here we go. So this candle here is your large news candle. And what happened here today was there was, out of the UK, was the UK inflation report. Now, the consumer price index had been falling of late, and this led to the decision not to raise rates for the Bank of England in May. The annual headline CPI fell to about 2.4% in May and was projected to rise to 2.6%, and the core CPI was expected to remain stable at 2.1%. Now, let's go and have a look at the miss on the, let's have a look, a miss on the calendar, and we'll have a look on HYCM calendar. Okay. And we'll just have a look at the extent of that miss as we talk it through. Wednesday. Where were we? Oh, here we go. Okay, so where's the core reading? Yeah, so you can see we've got the year-on-year core reading at 2.4%, and it was 2.6% expected. The core consumer price index reading for June was 1.9% versus 2.2% expected. Some of those figures are slightly different depending on whether you get from Reuters or Bloomberg or your HYCM calendar. Different feeds have different consensus, but you know, the key issue to take away is that that was a miss, and that was a significant miss for the pound. And question marks now start to get asked: what is going to happen with the pound? And if we look, we've got some key data out this week as well. The key data we got out, we've got some more data coming out for the UK tomorrow. We've got retail sales coming out tomorrow. That's going to be eyed as well. So the question that's starting to be asked now is, okay, the Bank of England has kind of been assumed that it's going to be raising interest rates on the 2nd of August. But with that inflation data coming out, that raises questions. It may not be. And you can see, as you zoom out the charts, you can see, look, that's quite a key level here. That's a key support level. See that zone? You can see, okay, we're bashing through there. And then you're thinking, well, you can see it, support there, and then look, okay, we're starting to get some resistance from this level. So how would you have used your Fibonacci tool here? Well, this is what you would simply have done. Right, you would have clicked on your tool, and then remember, you go from left to right. Now, in this scenario, you've got two options. You can do from here down to the bottom and have that as your swing, or you can do it from here down to the bottom and have that as your swing. Doesn't really matter. Personally, I went for a tighter data kind of a point, thinking, okay, this is significant, so I wanted to go for like the 61.8% kind of region. And obviously, the benefit of that is you can place your stop above the high. So you would have drawn your Fibonacci retracements tool, and you would have put a sell limit order in. Now, what we'll do is we'll just enter a market here to give you some experience for you guys. So sell by market there. We'll place the stop above the high, and then we'll just place. Now, let's put our target. Let's just put it so anywhere from anywhere from about here. That should be okay. And so you're risking 287 euros to make 332. Now, that is how you would use your Fibonacci tool. Now, obviously, you could have seen this and you could have got in at 38.2, but you see, obviously, you would be underwater now. Your position will be underwater, and you only really go for that kind of retracement if you're expecting price to really zoom on down and keep going. And if, like, it was a much bigger miss with the CPI data, then yeah, okay, you could have considered it 38.2. But it was a miss, but it doesn't totally rule out the prospect of a Bank of England hike. But it's certainly going to put a little bit of bearish pressure into the pound. And if you are wrong in your analysis, you know you've got your stop there to take you out. One thing that I would say about using this tool as well for your stop placement. So what you could do is, obviously, you put your stop there, but some people will use like the 78 level, and they will use that as a alternative stop, because if price gets that high, then it's possible that it's going to keep carrying on. Now, what I would do in this scenario is, and I like to kind of limit and reduce my risk within a trade as much as I can. So say price starts going down here to this kind of region, okay, then I'll bring my stop down either just above this high, or bring it down to break even. So if you bring it down to that high, you can see you reduced your risk straight away. Say price, it carries on going up and it bounces around, it goes up to here, and then say from there it sort of drops down to 50, or you can see another swing point, then I'll just bring my stop down below the most recent high, and that way you're just limiting your risk. So if the trade does go against you, look, you've managed to take some more risk out of the trade. And if you do that habitually, then you're ensuring that your winners are always greater than your losers. So that's just like a worked example for you. It gives you an example of how to do it. We'll go back to our presentation. Where is it? Okay. There we go. Okay. Moving averages. Now, some of the most popular aspects of support and resistance are moving averages. And the most important moving averages are the 50, 100, and 200 moving averages. These are the moving averages that are used by institutions, large funds. You'll often, if you're reading some news or analysis reports, they'll be talking about, oh, the 200 moving average, oh, the 100 moving averages. And all the moving average does is just show what the average price has been over the last 50, 100, or 200 periods. And they can be really useful in providing good places to enter the market. In a little bit of a similar way to support and resistance, they're popular, they're eyed by lots of traders. So there's a kind of self-fulfilling prophecy. And sometimes it is a bit like, well, where's a good place to enter the market? Say you're convinced, I really want to buy a certain pair, but I just, I don't know where to buy it. You don't want to just get in and buy, because you might have to endure a lot of drawdown. Even if you're correct on the overall direction, if you just enter the market at the highs, you've got to wait for a lot of drawdown, which is very draining and psychologically very tough. And also, if you're actually wrong in your analysis, it's going to become very expensive if you're not getting it right, every single time. So you're just putting more pressure on yourself, and you're making your psychology a lot more difficult. So if you have a look, and there's different types of moving averages as well, and there's the SMA and the EMA. So you've got your simple moving average and your exponential moving average. Now, you might think to yourself, well, what's the difference between the two? Well, the difference is one of kind of responsiveness. So the SMA is slower to respond to price. It's due to the way that they're calculated. You can Google it and have a look if you're really interested in the way they're calculated. And the EMA is a faster response. It responds more quickly to price. So the benefit of the EMA is that you can use it to identify trend changes much more quickly. With the SMA, is slower, it's less responsive, but maybe it's better for for those long-term trends. It's arguably more reliable. With the EMA, you're going to end up getting potentially stopped out more because it's more responsive, and it's a bit harder to judge. So you've got to make your own mind up. Maybe put them both on the screen. We'll have a little look at them both in a minute, and we'll show you how to do them. Okay, here's just an example of using the 200 and 100 moving averages. Kind of a sensible place to limit risk. One thing that's been known is that the Swiss National Bank, has been buying and supporting the euro-Swiss franc pair by buying it up to avoid the Swiss franc becoming too strong. Now, obviously, we know 2000 and I think it was 15 when they removed the 1.2 peg. So they removed the 1.2 peg, but even after that, they were buying up the euro pair just to make sure the Swiss franc didn't come too strong. So you could have known, look, the Swiss National Bank are buying up the pair, and you're thinking, well, where's a good place to get long? So a good place to get long would have been any time that price returned to the average, because look, okay, we know in all likelihood the euro is going to be bought up, so every time it goes back to around average price, that's just a perfect place to buy. So you could have used here, look, you could have, once price broke through the 200 moving average, you could have entered markets here, and you could have placed your stop down, just put a couple of 100 points stop on it there. And when price broke down here and tested that weekly moving average, that would have been a good place to have entered long. You can really the good thing about this is you've got the combination of the 200 and the 100 moving average in virtually the same location, and you've got the warnings, the potentials of a 100, 200 MA across. So you could have put your stops there, just the other side of the moving average entry. You know, that would have been a sensible place to have put them. You know, you want to have a look at the charts. Now, this is an example of a trade I entered this morning, and it's a New Zealand dollar US dollar short trade. You know, I was in and I got out on this candle here. Well, I re-entered the market this morning just for a very short trade. Just made a few, you know, can't remember, 20 or 30 points. So it was just an intraday trade, and I'll show you what I did with that, just out of interest. Yeah, there's our pound dollar trade. A little bit of selling interest coming in there. Okay, we'll leave that for now. Okay, so looking at the New Zealand US dollar chart, I'll show you how I use the moving averages here on the 1 hour chart. Now, okay, so came to the, obviously you had that increase of inflation for the Royal Bank of New Zealand, when, you know, it hit 1.7%. It was a bit of an uptick. Everyone was New Zealand dollar was bought up. Obviously, when inflation increases, people think that a bank's more likely to raise their interest rates. That's typically the way it happens. Higher inflation, pretty much the only tool the central bank has to handle that high inflation is to raise interest rates. So, okay, higher inflation. What the Royal Bank of New Zealand expecting to be dovish, expected to be a bit of a downer on the CPI. Wasn't. So price rallied. But, you know, is that going to suddenly make the, you know, the Royal Bank of New Zealand bullish? Are they going to suddenly hike rates? No, they're not. So, you know, combined with US dollar strength, Jerome Powell was out yesterday. He gave a speech and he was saying, you know, the US economy's doing great. You know, he was all more optimistic, more bullish. So quite quickly, the US dollar strengthened, and so the pair started selling off. So when I came to my desk this morning, I saw, okay, you know, we got strong US dollar. We had the CPI from New Zealand, but, you know, hey, you know, that's not like really anything to massively change the sentiment, and that was kind of yesterday's news, and all the gains had kind of gone. So all the buyers here, they've either taken their profit, or by the time price hits here, that, you know, they're underwater and they're thinking, what have I done? So especially, you know, any speculators, short-term speculators. So I was quite confident as I saw this morning. What I saw was like there was a slight divergence in price. Now this is a bit trickier to explain, so I won't. But I thought to myself, you know, there was a bit of a confluence here, and just around this kind of level here, I sold the market short just when I was seeing stochastics turning to the downside. There's a slight bearish divergence. I thought, oh, I can pop my stop here above the 200 SMA. Normally I put it a little bit tighter, but I thought, oh, that's a good place. I'll just put my stop here above the 100 and 200 moving average. And as I, you know, and then I was like, had a bit of breakfast with my children, had a shower, came back, and I saw price was like just around here, 6.7, like 4.7, and I thought, oh, do you know what? That'll do, because that's pretty much what I risked. I risked about the same amount. I've made pretty much what I risked. And it wasn't a trade to hold for a long time because of the nature of it. It was much more sentiment based, and US dollar strength was still going on. And, you know, I was thinking, well, do I want to try and hold for these lows down here? But as we've already discussed with the New Zealand US dollar, no, I didn't. This was becoming a bit of a support level, and there was that inflation data out that, okay, although it wasn't, you know, it's not going to make the New Zealand dollar bullish, it's still a little bit of bullish sentiment into the market. So as it turns out, you know, I took profit at the perfect location. I think I took it at 6.747. So, you know, 30 odd points. So quite happy with that. But that was just an example of how to use it. And you can see this like being used all the time. They're really good places to enter. You can see recently there's been a bit of a bullish run on the dollar yen, and you could have thought to yourself, if you wanted to get into this bullish run, you got your sentiment reasons. You thought, okay, the 100 moving average would have been a really good place to have entered on the 4-hour chart. Again, you got it on the 1-hour chart. You've got a good entrance there. And even, even on the lower time frames, you've got, over the last few days, you've got, you can see, how widely they're followed. Just look at that, all those reactions off the 100 moving average. That's like, it's clearly a technical line in the sand for traders. So it's it's one to watch. I think I'll quickly show you the difference between the SMA and the EMA. That would be quite useful for you to see. I think what pair should we look at? You can see it's starting to come off to the downside. Now that trade we were looking at earlier that we did together on the pound US dollar. Let's see, this may not be the most helpful pair to look at. We'll go back to the dollar yen because it's probably a bit more helpful for now. And we'll just change that. So this, if you want to put your moving average on the chart, just go insert, indicators, trend, and moving average. So you do, okay? And then once you do that, you get few options here. So if we want to turn that into the simple moving average, there we go. And we're going to turn it to the simple moving average. Yeah, and you can see that it's quite a different feel. So there, that SMA was used here. And you can see buyers lent against it here as well. And the 200 moving average is lent against there. So that's an example. I personally prefer the EMA. That is just a preference. And it really doesn't, in one sense, it doesn't really matter. And you could always have a look at both if you really wanted to. Okay, right. Let's go back to our there it is. Go back to our presentation. Now that was the New Zealand US dollar and how I use the 100 and 200 moving average for an intraday trade. I hope you found that useful. And another area of support and resistance that's really worth being aware of is pivot points. Now, pivot points are widely followed by funds, institutions. It's just a really, really well-respected support and resistance levels. You can find these, you can Google them and get them. You get different types of pivot points. Here on this chart here, as I've got like standard pivot points for your 1-hour chart. And I just thought, again, I just go through how to use this to give you a little bit of guidance. So say you'd see the CPI data coming out for the UK, and you thought, oh, I really want to sell the pound. I sold the pound CAD this morning on the data, took a spike out, and now I'm trying to. Now I sold a bit of pound Swiss franc, took a spike out of that, and then I'm looking at trying a retracement to those pairs. So let's say you did the same, and you're wanting to think, well, how do I get into this? Well, we've seen some of the different tools, haven't we? We've seen using the moving averages. We've seen using support and resistance. We've seen using Fibonacci. And now let's say we want to use pivot points. So you can see we want to sell from resistance. So resistance 1 is 1.3063, resistance 2 is 1.3076, and resistance 3 is 1.3087. Okay, so we go to our chart, and then going to our chart, you can see price beginning to pull off down to the downside. Sorry, let me just, yeah, okay. Let me enlarge the screen. Okay, now I'm just going to take the Fibonacci tool off there for now, and we're going to look at the pivot points. So resistance 1 level was 1.3063. Okay, so your first pivot point was here, 1.3063. Second point was 1.3078. Okay, and your third was 1.3087. Okay, so on the 1 hour chart, there were the 3 pivot points. Now, what you want to do is you want to try to marry as many of these levels together as you possibly can. So this is quite a good example on the British pound, the sort of thing that you want to be looking at. You've put your Fibonacci tool on, okay, and now you start thinking, well, okay, where is a really sensible place to enter short? I want to limit my risk. So you're thinking, oh, okay, look, there was a bit of support here. Okay, so that support is there. Yeah, okay, that's a sensible place. Zoom out. See, that's a very sensible place, you know, quite a big support level. You know that you've got your resistance point, 1.3063 is your first resistance level. And you're thinking, bear in mind, look, so all of a sudden I'm thinking, okay, I've got the 61.8 fib that coincides with the 1.3063 resistance level, which coincides with this recent support level. And, you know, you're thinking, okay, well, you know, and if you drew the fib from kind of a bit higher up, it's also the 23.6 kind of level from the whole swing down. So you put all of that together and you know, you really built a decent picture of what to do there. So that's just an example for you guys. Have a look, watch that trade yourself. I have to say that this is not trading advice. This is simply education. I'm showing you how to use these tools. I'm showing you the correct way of using them for support, for resistance, for entries, for exits. So it's not trading advice. And the other thing that I need to make you aware of is don't use these support and resistance levels on their own, because you'll find they won't work for you. Because you'll find a great level, you think, wow, I found a brilliant support level or brilliant moving average or a great fib level, and I'll just put my entry and put my exit there. Oh, it didn't work. That's because they have to be used with sentimental and fundamental analysis. They don't work on their own, because traders all around the world are not just looking at charts and looking for 200 moving averages. They are looking constantly at news feeds. What's the latest news? What's the biggest mover? What's at the focus of the markets? And you've got to use them with sentiment and fundamental analysis. If you find that a bit difficult to grasp, well, we've done a webinar already on understanding market sentiment. So if market sentiment is new to you, just go and check out the webinar. It's an hour-long webinar, and it will give you a really good understanding what market sentiment is. And I do hope to do in the future one on fundamental analysis as well. So you can have the two together, and once you've got those two and the technical analysis, you're pretty much getting the fundamental tools that you need. Next week, I'm doing a seminar on knowing which currency pairs to trade. Now, this is going to be a very important webinar. It's going to help you identify which are the correct pairs to trade. How do I know which pairs to trade? I'm going to guide you, I'm going to direct you, and I'm going to help you on that. So do pop in next week, same time, same place. And of course, don't miss the FX week ahead. That's live market analysis, GMT 12:30 to 1 o'clock GMT time. I'm going to look through the week, find the most relevant market analysis for you guys, so guys can know which events do I focus on and which events could I ignore, because not all events are created equal. Some are really anticipated, some are really significant, others are not. I'm going to help guide you on that process and begin to help you to identify those for yourselves. Okay, guys, you have a really good week. Thank you for listening, and I hope to see some of you again at the next webinar. Just give everyone a moment for any questions. If you've got any questions at all, please do ask and I'll try and help you. Okay, that's great. There's no questions here. Thank you. Bye.